Mr. Prashant Khemka, who's next in line. He's already in the room. And brief word of introduction about Mr. Khemka. You're on mute, Mr. Khemka. Prashantji is the founder of White Oak Capital Group of Companies, a boutique investment advisory firm. He launched White Oak Capital in June 2017, simultaneously in India, Singapore, Mauritius, and over the years have geographically expanded it to London and Switzerland. So all the places where money is, White Oak is there. Prior to setting up his own firm, he spent 17 years at Goldman Sachs, and was lead PM of Global Emerging Market Equity India and Equity Strategies. As the CIO and lead PM of GS Goldman Sachs India Equity, he and his fund won several accolades and awards, including AAA rating from Citibaya and elite rating from Fund Caliber, amongst others. Prashantji started his investing career in 1988 at SSGA in Boston as Senior Portfolio Officer of Enhanced International Equity in the Quant Group. He has graduated with honors from Mumbai University with a BE in Mechanical Engineering and earned an MBA in Finance from Vanderbilt University, where he received the Matt Wigginton Leadership Award for Outstanding Performance in Finance. He was awarded the CFA designation in the year 2000 and is a fellow of the Ananta Aspen Center in India. With these words, Prashantji, the floor is all yours.
Thank you.
Very eager to listen to you.
Thank you so much, Alok. Thank you. I also just happened to speak to Dr. Wispy 5-10 minutes ago. I don't see him here, but I want to thank him also for inviting me here and thank the forum, BSE Forum, for organizing this. I was told that I can speak. I asked what should I talk about. So I was said anything, your perspective on investing, whatever I'd like to share. So I started thinking, I said 20 minutes I usually take to start. So to say something material and meaningful in 20 minutes, so I might as well, just focus on one particular thing rather than a lot of different things, which has been, I would say, and I've often said this, I don't write too much because I'm a poor writer, but to the extent that I've badly written, but to the extent I've written, I've written about this topic, which is the futility of, and I think it's been relevant at all times, and today also remains very, very relevant, which is market timing related questions. So people presently feel that the market is at a certain level, that it's cause for worry. And people oftentimes think that, okay, it was fine a year ago, 2 years ago, 3 years ago, market was fine, but today it is at a level that is worrisome. But the reality is that the very same people are almost always worried about the market. They were worried a year ago. They were worried at the bottom of March 2020 also. They were very worried when COVID was just picking up. They were worried at almost every time. Either they're worried about bad macro outlook, like in 2020 March, macro looked very bad. So they're worried, number of cases are rising. By the way, the market bottomed on March 23rd, when there were single-digit deaths in India, and there were double-digit, not double-digit thousands, but double-digit numbers, 75 cases per day all over India. And the total cumulative case count had still not crossed 1,000, right? Today we are on, I don't know how many, in reality we are in, I don't know how many crores, what is reported maybe not as relevant. And then, so people got very worried about what's happening in Wuhan and all that. And then markets started rallying, as we all know. And all throughout, for at least next 12 months, people were so focused on the number of case count and all that and scratching their heads. Okay, there's a dichotomy between the market and the reality. So when the macro is bad, people are like, oh, macro is bad. They don't care for what the value is. And then when macro looks good, people are like, oh, the valuation is so high. So does it really make sense? So today we are kind of, everyone kind of has formed a consensus that future for India is bright. and things are going to accelerate. Economic growth is going to accelerate. All the pundits on the TV and in the media are saying pretty much the same thing. The reality is that what the pundits say is also function of where the market is, rather than the other way around. But the point is, almost all the time, investors worry about where the market is headed. And that my biggest lesson over the last few decades, and Alok ji, you very kindly gave the introduction, but I must add that my first crush, obviously, when I grew up as a child in Bombay, like most Indians, I wanted to be the captain of Indian cricket team and beat Pakistan, right? But then at the age of 13 in 1985, I fell in love with stocks because that was the year when Rajiv Gandhi had become prime minister and Sensex went up 100% till date. That is the biggest calendar year for stocks. Sensex 100, it was 99 point some 9% or something like that. So I thought I can double my money every year. I had 5,000 rupees in my piggy bank, and I thought I can become a crorepati in 11 years if I double every year. It's a legal, ethical, moral way. You don't have to bribe anyone, and you can become a crorepati. Remember that days crorepati meant a lot. Today it might not, but I'm talking about 1985. So I soon learned that it's not so easy to double your money every year. But one of the first lessons that I learned, and that has served me extraordinarily well till date, and in my view, that is one of the biggest, in fact, that is the biggest reason for. Um, in India, there are many good managers, fund managers, but we all know that globally, outperforming the benchmark or being above average, above the benchmark is considered very difficult. And the number one reason in my mind for failure of fund managers is that they get trapped into trying to time the market, macro calls, and all that. And that was one of my first lessons, that trying to call the market or time the market is not merely very difficult, but it is impossible. And that I was inspired by, or it struck me when I saw the movie Dawn around that time. Dawn, where there is a dialogue which we use at White Oak in our marketing material. So, Dawn को पकड़ना मुश्किल ही नहीं नामुमकिन है. Forget the movie में Dawn फिर भी पकड़ा जाता है, but in market, to time the market is not merely difficult, it's impossible. And people have to realize there's a huge difference between something that is impossible and something that is very difficult. Because when you say something is very difficult, it means someone is an expert enough to be able to do it with great difficulty, right? But when you say it is impossible, it is impossible. It is not very difficult. And it is our view. We tell our clients all the time globally, we have zero confidence in our ability to time the market. Clients still ask us all the time, but we have zero confidence in our ability to time the market. But at the same time, we have zero confidence in any of our peer group's ability to time the market. Now, sometimes the clients do get offended because clients are clients, maybe not the end client, but the CIO or someone whose job is to try and time the market. So there's a sense of, job question mark that I'm putting on the job. So I clarify, as a stock picker, it is impossible. Maybe if you do it 365 days as a macro investor, maybe I leave the doubt so as to not offend anyone. But reality is, it is just as difficult for anyone of you or me or anyone in the audience as it is for, be it Warren Buffett or anyone or the lay person. It is like coin flip में you can do a PhD in Stanford or Harvard. They do PhDs in probability theory and all that. Yeah, coin flip is in a way part of most basic form of probability theory. You can do PhD and yet you would be no better than the lay person in predicting the next coin flip. Right? Just like Kohli and Dhoni are the best of the cricketers and captains they've been to lead the Indian team, but they are no better. It's very evident from Kohli's track record. They are no better at predicting the coin toss at the start of the game than you or me or my mom. So, a fund manager, no matter how good his or her track record is, you think of them as maybe Dhoni or Kohli playing cricket, but they're no better at coin flip at the start of the game. And similarly, no fund manager, no matter how smart the person sounds, is any better at predicting the market going forward than anyone else. Where money can be made is stock selection and stock picking. Because stock picking is not like coin flipping. Stock picking, if I were to continue the gaming analogy somewhat, is like playing bridge or poker. In bridge, if your team, you and your partner, really develop the skill and capability, you can beat any other team in the world and be the world champion. Yeah, in a particular game, it can be that you get such terrible cards that the other party made seven no trumps or whatever, and you have no chance to win. But during the course of an evening of 20, 30 games, the luck factor would even out, and what would come through is your capability. And if you are indeed the best team in the world, you can win the World Cup. And same is true for stock picking. One or two or certain number of stocks can go wrong, but if you have a portfolio of 20, 30, 40, 50 stocks through time, if you are an outstanding fund manager, then your performance would bear it out in time. So, stock selection is like playing bridge or poker, and trying to time the market is like flipping coins. In one, skill can be developed and applied to your benefit. In the other, skill, by the nature of the beast, skill cannot be developed. Now, market timing is coin flipping. What about top down other macro bets? Fed is increasing rates, decreasing rates. I mean, over the last 13 years, uh, there's been a universal preoccupation amongst investors and other people associated with our industry with what the Fed is going to do and how is it going to impact us. I mean, every client asks me as if it is a de facto conclusion that Fed is going to increase rates and interest rates are going to that is going to lead to increase in interest rates overall, and that is going to result in decline in stock prices. And so all these macro bets or top down sector rotation, banking is going to do well, pharma is going to do well. Remember when COVID struck, there was universal consensus pharma is the sector for the next decade. अब pharma का time आ गया because it had underperformed for 3, 4, 5 years and it started outperforming. Where is pharma today? Nowhere, right? So all these sectoral calls, these are all top-down approaches. These fall, in our view of the world, fall close to or on top of coin flipping, whereas stock picking is really where skill can be developed. Now, just don't take it from me, but go. I would encourage people who are listening here to go and read what some of the gurus themselves have written. People whom everyone in the audience might hold in very high regard, right? But they don't always follow them. They selectively follow them, not always follow them, right? Now let's look at, if you read enough of Warren Buffett, it would be clear that he doesn't try to time the market. His own track record is probably miserable at least recent track record would be. So it's easy to say buy when, no, what is it? Be greedy when everyone is fearful and be fearful when everyone is greedy. How many people really were greedy in March of 2020, despite repeating this ad nauseum, right? And obviously, it's like a coin flip. Not 100% of the people are going to get wrong. Typically, 50-50 is what the outcome would be. And in fact, if you see, Berkshire ended up selling more stock than almost anyone in the sharp crash of March 2020. All the financial stocks and airline stocks and all, because it's very easier said that buy low, sell high. Impossible to, practice. So here, I believe Peter Lynch has put it very, very nicely. Few of his comments, and a lot of people have said, in different ways. So before I come to Peter Lynch, somebody has said that investor returns are a function of time in the market rather than timing the market. That is very true. I mean, Sensex has delivered over the last 36 years 15% compounded return. Right? So at that pace of compounding, 1 lakh rupee invested or 1 crore, let's start with the little numbers which in today's 1 lakh 35 years pehle 1 lakh could have been the example, but today's example, let's start with 1 crore. Not many people had 1 crore back then, though. Though the audience is fairly well-to-do audience, so they probably had 1 crore back then also. So 1 crore starting in 1985 till today would have been in Sensex been approximately 150 crores in fixed deposit. So because 15% growth rate, I'm amazed at how some of the smartest businessmen, I posed this question to billionaires, who self-made billionaires, smart businessmen. Okay, I tell them, okay, tell me if you had 1 crore in 1985 and you had put it in fixed deposit, what and earned SBI ka after tax fixed deposit has earned 6%. आज की तारीख में तो 3-4% भी नहीं है, 3% है probably, but 6% from 1985, 1 crore would have translated to 8 crores today at 6% rate. How much would have Sensex translated into at 15% rate? People usually don't get it right. This is 6%, 15%, maybe कोई बोलता है 30 crores, कोई 50 crores, कोई 60 crores. It has gone to 140 crores or thereabouts. Just ETF Sensex का रखते तो. And if by developing a,
include dividends? Would that include dividends?
I have not included, but उसमें और 1% डाल दोगे तो और कुछ ज़्यादा होगा. मैंने सिर्फ price chart लिया, but good point,
Sure,
because every
sure.
percentage points makes a big difference.
Absolutely.
Now, you were to, if you had developed a skill of stock picking, and let's say it's not easy, but let's assume for a minute, if you were able to generate 10% alpha or outperformance, और 15% की जगह 25%, 25% was the return what you could have achieved, and many people have achieved. Maybe it is still only 1 or 2% of the people who achieved, but 1 or 2% out of tens of thousands of people who were invested in the market still would result in hundreds of people who would have achieved 25% return over this time compounded. At 25%, when I asked this question, what would 1 crore become? The person goes like 15% pay, Kariban 1 crore has become 150 crores. So 25% pay must be 250 crores. I'm like, think again, maybe 300 crores. And I request all of you who are in the audience to guess for themselves what it would have become at 25% return. I'll just pause for 5 seconds for you to firm up your guess. 1, 2, 3, 4, 5. And the answer is 2,800 crores.
Wow.
1 crore would have become 2,800 crores. So, to me, for someone who can invest well in the market, and that should be what all of our attempts should be, the choice for me is या तो मैं fixed deposit में रखूं तो 1 crore had become 8 crores, or I identify outperforming portfolio which 1 crore will become 2,800 crore. The difference is so humongous, 350 times or something more wealth. It's not worth trying to time the market, because when you're trying to time the market, you are staying in cash for that much time, right? And remember what I just said, that's very true. You can apply it to yourself. The investor returns are a function of time in the market rather than timing the market.
Right.
If you had tried to time the market during this 28 years and you were out, let's say, for 5 years or 3 years cumulatively, you would have earned in proportion that much less return. Sometimes you would have been right, sometimes you would have been wrong. If you were lucky, you would be proportionately right. Most of the people, actually, the reason worldwide retail investors make less return than the market is not fund manager fees, but it's their own fault of timing the market. Probably all of us know so many people who got out of the market in March 2020, right? So many people who got out in the November 2008. So you get out of the worst time and then get back 100% higher. That's a huge, if you miss, you do once, वो 2800 crore का सीधा 1400 crore हो गया है एक बार 100% का मूव if you miss 100% move, right? So the cost, opportunity cost is so high. If by staying fully invested, doing better stock picking, forget 25%. If you can earn 15% return also, you know, 20%, 15%, whatever return you can earn, it's so much higher than it's not
That's
worth engaging in a coin flip like bet,
true.
हाँ, which has no value add whatsoever. एक बार कोई right हो गया तो it's selective memory. It's totally selective memory. You are right once and then you pay 10 times and still you remember the one time that you were right. It's like, when survey is done in US of people who go to Las Vegas, survey after survey show that majority of the people, a big majority of the people believe they have been winning at Vegas and they will win at Vegas. If that were true, Vegas would have been shut long ago.
Yes, yes, yes.
Reason people believe this is because of selective memory. They're like, yeah, we've been winning. Once they win and they remember the win, right? In a way, it's good for human sanity. Agar these are optimist people. It's good that they remember their successes. But that is exactly how it is in the market. So if I've spent now nearly 20 minutes and I believe it's time up for me. But if there's
Absolutely.
my number one most useful lesson, most valuable lesson that I fortunately learned very early in life, and I keep saying this to all my investors, is determine how much of your net worth you want to be invested. For me, 100% of net worth is invested in the market. I don't, yeah, sleep well. I can't sleep well if less than 100% is invested in the market, right? But
At least you're not leveraged.
well, no longer. I used to be playing all on leverage. That time my father bailed me out, but now he can't bail me out. So I don't lever up, but yes, 100% invested in the market. And yes, in the peak of 2000, I was 100% invested, but fortunately, then at the bottom of 2003, I was 100% invested. At the peak of 2008, 100%, but then the bottom of 2009, March 09, 100% invested. Ultimately, you end up far better position than if you are trying to get in and out of the market. So I can go on this topic. I can someday would probably write a book on this topic, but in the interest of time, uh, I would close my talk at this point and want to once again thank you all for listening and thank you to BSC for Traders Forum for giving me this opportunity to talk with the audience.